Hi, everybody. This is Ellman, the blue collar investor, welcoming you to this BCI podcast number 62, titled, Should I Unwind My Covered Call Trade 1 Week Prior to Contract Expiration? We're going to be using a real life example with Alibaba Group Holding Limited, which trades on the New York Stock Exchange under the ticker symbol BABA. Now, there are two circumstances under which we would consider unwinding the entire covered call trade prior to the contract expiration. One would be if the share price is declining significantly, which means that it's underperforming the overall market or the S&P 500, and some investors create a guideline if the stock price drops between 7 and 10% from when the trade was first entered. So that would be using an example when the stock price declines. The other circumstance is the opposite, when the stock price actually goes up substantially. Now, when that happens, the time value cost to close on the option leg of a covered call trade approaches zero. Now, the intrinsic value component of the premium gets higher and higher because that's the amount that the strike price is less than the current market value of the stock. So if the stock price is going higher, the intrinsic value also gets higher. So it'll cost us more to close the trade. However, that intrinsic value component is neutralized by the increased value in our shares. Before buying back the option, our shares can only be worth what the original strike was because that's our contract obligation. By removing that obligation, our share price is now worth current market value. So when we look to see what does it actually cost us to close that in the money strike, it's the time value component that we need to focus in on. And then we ask ourselves the following question. If we do close because the stock price went up and the time value went down, can we generate at least 1% more than the time value cost to close by the end of the contract? The answer is yes, then it may make sense to unwind. If the answer is no, then it does not make sense to do so. So let's take a look at a trade with Alibaba, which Rob was very kind to share with the BCI community. And this goes back to July 25th when Rob shared this email with me. And here are the trades from Rob's portfolio. On June 17th, 2019, BABA was bought at 173.54. Immediately, the August 2nd 175 out of the money call was sold for $2.35. This is a 6-week return of $235 per contract. Now, 1 week prior to contract expiration, the stock was trading at 178, meaning the 175 was $3 in the money. The cost to close that 175 strike was $4.78. Now let's, before we go on to see whether or not it makes sense to unwind that trade, let's see how the initial structuring of that trade looked. And we're going to use the multiple tab of the Ellman calculator to give us these results. So with Alibaba trading at 173.54, the 175 strike was sold at 235. The calculator tells us that the return on our option, the time value return, was 1.4% for the 6 weeks. Now, we had a slight bit of upside potential if the stock price moved from 173.54 up to the 175 strike. That means the total maximum return for this 6-week trade was 2.2%. So that's how the trade was structured. Now let's see what it would cost us to unwind that trade. So we look to the Unwind Now tab of the Elite version of the Ellman calculator or our Elite Plus calculator, and we put in that information. So the stock price purchase was 173.54. The strike sold was the 175 for 235. Now, on July 25th, the stock price was 178, and the cost to close, the original strike was $478. The Unwind Now tab of the elite versions of the calculator tell us that the time value cost to close is $178 per contract, which is 1.02%. That is the cost to close, 1.02%. Now, you recall the maximum return that we can get was 2.2%. So that's losing about half of our maximum results with 1 week left. Now, a maximum total 5-week return or 6-week return was 2.2%. Now, the cost to close is 1.02%. Can we generate 1% more than 1.02% or 2.02% by contract expiration? It's only a week away. Okay, the answer is probably not. So unwinding in this particular case with Rob's trade does not appear to be in our best interest. What we do instead is to take no action, but we continue to monitor our trade. Now, a week later, if the strike is still in the money, then we evaluate rolling our options to see if that's a possibility to retain the shares in our portfolio for the next contract month. So we work all the math out, and we use the What Now tab of the Ellman and Elite Plus calculators. Okay, so that takes care of that. Now I just want to remind you that for a free copy of the basic Ellman calculator, which does have the What Now tab, but not the Unwind Now tab, as I said, that you'll find in the Elite version of the Ellman calculator and the Elite Plus calculators. But for a free copy of the basic version, you can get that at the free resources link located on all of our web pages. Just go to www.thebluecollarinvestor.com, click on that link, put in your email address, and you can download that, plus a free put calculator and many more free resources. Also, feel free to have a look at the hundreds of articles that I've written over the years. We have a free beginner's corner tutorial for covered call writing, selling cash secured puts. Now, if you want to really take this to a master level, have a look in our store, www.thebluecollarinvestor.com/store, where we have our online video tutorials, online DVD programs with downloadable workbooks, a series of calculators that I've created to do all the numbers for you. So if you're mathematically challenged, like most, the calculators will do all the heavy lifting for you. We also have books in various formats and PDFs. We have books in softcover and a few in hardcover as well. Further down in the store, you'll see our trade planner and mentoring programs. So, ladies and gentlemen, that ends our BCI podcast number 62. Should I unwind my covered call trade 1 week prior to contract expiration? And we've given you the parameters to help you make those very important decisions. So thanks to all for taking the time to listen to and some watch this podcast. I hope you enjoyed it. And most importantly, I hope it puts cash in your pocket. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.